Welcome to the Financial Quarterback with your host, Jim Lineweaver.
Hi, I'm Jim Lineweaver, your financial quarterback since 1993. Today's program is designed to help you coordinate all your financial, tax, legal, and insurance to try to help you save time, money, and worry. Today's topic is tax tips for the business owners out there, and we have special guest Mark Cypus with us. He runs the tax division of our company, so thanks for coming on the show.
Thanks for having me back.
So now, Mark, I know you provide a lot of great advice for individuals and corporate strategies to save taxes and stuff, but this new tax law, it sounds like a lot of business owners, whether it be direct income or passive income, are going to get a 20% deduction.
That's correct. It's called qualified business income, and that's for income from sole proprietorships, pass-throughs such as S-corps and partnerships, rental properties, including REIT income. But keep in mind with the rental properties, they still must meet the standards for a trade or business.
Now, do all types of businesses get this 20% deduction?
Unfortunately, no. The IRS has carved out what they called specified service businesses. An example of that would be accounting firms, law firms, financial advisors and brokerage firms, health fields, and many more. A complete list is on their website.
So it figures that we fall into that category.
Of course.
But outside of that, if you lose that, is there still other ways you might be able to benefit?
Yeah, if you're under certain income limitations, you still qualify for the 20%. Also, once you hit that income limit, there's phase-out rules, so you might qualify partially.
So this is obviously a great benefit for business owners and the self-employed, but can you get more out of it?
Yes, you can. You need to keep in mind that the 20% deduction is the lower of your business income or your taxable income. And by taxable income, I mean after all deductions. So self-employed health insurance deductions, an IRA or SEP IRA contribution, your itemized or standard deductions, all reduce your taxable income. So if you do a SEP IRA contribution, it could actually lower your 20% tax deduction. So you need to really coordinate those efforts and keep in mind that some of those could help you actually fall into the deduction as well.
And I know that's why one great service that you provide is doing a lot of pro forma estimates and stuff so people can make educated decisions. But if you don't qualify for that, there's still a great benefit under this 179 deduction that went all the way up to $1 million, right?
Correct. The Section 179 is a direct write-off of certain capital assets. And like you mentioned, it doubled from $500,000 to $1 million. They've also expanded what types of assets qualify and how many assets you may purchase throughout the year to qualify.
So there are a lot of great opportunities out there to save you money, especially with this 20% deduction and the Section 179 expense. That's why it's so important to try to coordinate all your financial, tax, legal, and insurance so you don't pay a dime more in taxes than you absolutely have to. Thanks for tuning into the show. Stay tuned for the Chris Wallace Show coming up next.